I asked AI to analyze over 65,000 live options trades, and these are the 5 biggest takeaways that it gave me. Number 5 might even surprise you. If you don't know who I am, my name is Austin Booley. I run a options automation company that literally does over $1 million in automated trades every single day, and I have access to so much data. I took all this data and I asked AI to analyze it to give us the 5 biggest takeaways that options traders just like you can use to adjust and tweak their strategy based on real data to increase your performance, increase your returns, and decrease your risk. So let's walk through each one of these. Number 1 is aim for 90 to 120 days until expiration. Over all the data that we looked at, it came down to a single factor that I've been talking about for a while, that 90 to 120 DTE when you're doing option selling is very important. 45 DTEs is typically the standard when it comes to option selling, but if you go out further out in time, like 90 to 120 DTE, you get better returns. Why? Because you have more time to be right in the trade. If something like this happens, you have more time for the market to recover and bounce so that you're back in profit level. So you have more time to be right, which increases your win rate. Number 2, when you go further out in time, you collect more premium, which allows you to have a higher profit. The higher profit allows you to offset losses better as well. And long term, you also decrease vega, which means volatility risk will decrease as well. So the number 1 takeaway from looking at over 65,000 live trades over the last year or so is that you should go to 90 to 120 DTE when you are an option seller. Number 2 is target mid-range premiums between $5 to $20. So that's what it found. I personally like to enter around the 45 credit dollar level, and I do this because when I enter at a $45 credit, that's typically what I'm collecting with a 112 trade, or something like $30 if I'm going with a 111 trade. Regardless, whatever option strategy you're doing, it shows that it's best between $5 and $20. Now, why these numbers? Typically, if you're going under $5, you're not collecting enough premium to actually offset any of the commissions, any of the losses, or anything like that. You're trying to pick up pennies in front of a steamroller. That's typically the idea, that you're not collecting enough profit to ever offset losses. If you go above $20, then what you tend to see is that you're pushing your risk parameters way too high. Because the more credit you receive, yes, the more profit you make, but the more loss you have. If you do a 200% stop loss on $40 of credit, it's a way larger loss. And so you're probably not keeping your risk to reward properly in check. So it found over the 65,000 trades, takeaway number 2 is keep your target credit between $5 to $20. Again, I know my numbers, which for my trades roughly are $30 around there. But again, remember, understand what good ranges are for your initial credit that you're receiving. Number 3, stick to proven automations, finding that the 112 and ES and CL performing the best. Okay, so there are so many different strategies you could use, and honestly, it best depends on what the market is doing for what you should be trading. If the market is uptrending, you should be using uptrending strategies. If it's downtrending, use downtrending strategies. This is the idea of our 4 core bots training, which you can go and watch down below in the description. But essentially what it's saying here is that overall, over the last year and a half or so of trades, 65,000 trades, the best performing trades were 112 trades. And why is this? A 112 trade is essentially a short put trade with a hedge built in. So it's a smoother performance return, but you're betting on the overall uptrend of the market. Why does this make sense? In general, the market trends up. So when you're betting with it, you're going to make more. And also what it's saying is ES and CL were one of the top symbols here. Why is this good? Futures options give you an insane amount of leverage, which means you can use less money and decrease your risk, but still make more. And not only that, you also get tax advantage like 60/40 tax treatment. And so ES and CL were found to be one of the better options. So if you have the ability to do futures options, you might want to look into ES or CL. If not, use something that models the overall market, because that's safer, more consistent, and more stable than going to a single asset is what would be my takeaway here. Number 4 is enter on Mondays and Fridays. This was a very interesting find. Again, out of 65,000 trades it analyzed, it found that the trades that had the highest performance long term were the trades entered on Monday and Friday. Now, why is this? For Friday, my guess is that you have the theta decay over the weekend, where as long as the market doesn't move too dramatically, you open up on Monday with a decent profit already due to about 3 days of theta decay. So that's one thing that's working out in your favor. Monday, typically the market opens, has a lot of volatility, but sometimes, and more times than not, whatever happens on Monday tends to set the precedent for the rest of the week. And so if you have a green Monday and you're taking advantage of it, you tend to have maybe a greener week as a whole. And so being able to enter on Monday or Friday were shown to be better days. Again, do your own research, do more data, diving into this. And I will myself, because I find this interesting. But so far, based on the 65,000 trades I gave it to analyze, Monday and Friday were the best days. And last but not least is use hedges strategically. It said the trades that had hedges performed 24% better and had an average profit of $400 versus the trades that didn't. So what is this saying? Again, that's something I say a lot, is that one strategy is not something you should rely on. A lot of people take one option strategy and that's the only thing they do. You need to pair your amazing bullish strategy, whether it's a short put, a put credit spread, 112, 111, whatever it is, and pair it with a hedge. It showed that of the trades that were paired with a hedge, the win rate increased by 24% and had a higher profit. Why? Because when things like this happen, you have hedges to offset your losses and even help you profit depending on how many hedges you have on. So those are the 5 biggest takeaways from analyzing over 65,000 live options trades, which is this shortly put. Number 1, stay between 90 to 120 DTE. Target mid-range premium between $5 and $20. Stick to proven strategies. Number 4, enter on Mondays and Fridays. Number 5, use hedges strategically. If you want to learn more about the options auto trader and you want to start using it to automate your own trading as well, then click the first link down there below so you can get more trading data so I can make more videos like this. If you enjoyed that, hit that subscribe button and I'll see you in the next video.